Here I will present a comprehensive income statement. The statement of comprehensive income reports the net equity of a business enterprise of a given period. The financial statement includes two case parts: income statement, which outlines the net income, and other comprehensive income, incorporates the items excluded from the income statement. Thank you for the opportunity. Good morning and bad wish all of to us. Okay, before that I will introduce myself. I am Anissa Fitria Salsabila and my last number is 590.
Assalamualaikum warahmatullahi wabarakatuh. My name is Apriliana Afifa. My student number is 591.
Assalamualaikum warahmatullahi wabarakatuh. Thank you for your opportunity. My name is Safira Rida Emilia. My last student number is 684.
Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. My name is Eka Pratiwi and my last name is 686.
Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. My name is Alfiana Rizkika Amalia Putri and my last student number is 706.
Income statement usefulness 1. Evaluate past performance. Evaluating the company's past performance by examining income expense, we can find out how the company is performing and compare with competitors. 2. Help assess the risk and uncertainty of achieving future cash flow. Help assess the risk and uncertainty of achieving future cash flow information about the various components of profit, income, expense, profit, and loss. So, the relationships among these components and can be used to access the risk of a firm value to achieve a certain levels of customer flow in the future. 3 is predict future performance. Predict future performance provides a basis of predicting future performance. Information about past performance can be used to determine import trends which, if continue, provide information about future performance. 2 is limitation. Limitation 1 is companies omit items that can be measured reliable. Report result from stakes and expense cannot be measured reliable, so they cannot be included in other income statement. The Financial Accounting Standard (SAK) provide a requirement that the stakes of or expense can be accurate and can be measured reliable. Limitation 2 is income numbers are affected by the accounting methods employment. The report income or profits will have an effect on the accounting methods used so that the different result will be different. Financial Accounting Standard (SAK) give companies the freedom to cost a method to depreciate fixed asset in accordance with approved company's policy. Limitation 3 is the result of the calculation of income and expense are required on involve management judgment. Quality of earnings. Companies have incentive to manage income. 1. To meet earnings targets. 2. To make earnings look less risk. Earning management is the planning of revenue, expense, gains, and loss to smooth out earnings. Quality of earnings is reduced if earnings management result in information that is less useful for predicting future earnings and cash flow.
Format of the income statement. Element of the income statement. Net income results from revenue, expenses, gain and loss transaction. The income statement summarizes the transaction. The method of income statement. The transaction approach focuses on income-related activities that have occurred during the period. The statement can further classify income by customer, product line, or function, by operation and non-operation, and by continuing and discontinued income. Increase in economic benefits during the accounting period in form of inflow or number of assets or decrease of liabilities that result in increase in equity other than those relating to contribution for shareholder. Element of the income statement. Expenses. Decrease in economic benefit during the accounting period in the form of outflow or decline of assets and increases of liabilities that result in decrease in equity other than those relating to distribution on shareholders.
And income includes both revenue and gains. 1. Revenues. Revenues ordinary active of a company, and gains may or may not arise from ordinary activities. And revenue accounts: 1. Sales revenue, 2. Fee revenue, and 3. Interest revenue, 4. Dividend revenue, and rent revenue. And gain accounts: 1. Gain on the sale of long-term assets, and realized gains on trading securities. Format of the income statement. Intermediate component. Company generally present some or all of the section and totals within the income statement can be seen in the table next to this. Sales or revenue, cost of goods sold, and gross profit. 1. Selling expense, administrative of general expense, and 3. Other income and expense. Income of from operation, financing costs. Income before income tax. Income from continuing operation, discontinued operation. Net income. 1. Non-controlling interest and earnings per share.
Thank you for your opportunity. My name is Fia Apelianur Afifa. My last name is 591. In here I will a brief reporting within the income statement. Gross profit. Gross profit is the profit a company makes after deduction in the cost associated with making and selling in product, or the cost associated with providing a service. Gross profit computed by deducting cost of goods sold from net sales, provided as useful number for evaluating performance and predicting future earnings. Usual or internal revenue are disclosed in other income and expenses. Reporting within the income statement. Income for operation. Income for operation is the amount before not operation items, such as gain and losses on the sale of assets, interest revenue, and interest expenses, determined by deduction selling and administrative expenses and as well as other income and expenses for gross profit, like items that after regular business activities, used to predict the amount, timing, and uncertainty of future cash flow. Income from operation, expenses classification, nature, and function. The nature is one cost of material used to direct labor included 3 delivery expenses, 4 advertising expenses, 5 employees benefit, 6 depreciation expenses, and 7 amortization expenses. Income from operation. From operation expenses classification. Function. One is cost of goods sold. Two selling expenses and three administrative expenses.
Gain and loss. Additional item that may need disclosed. The first, loss on write-downs of inventory to net realizable value or of property, plant and equipment. 2. Recoverable amount as well as reversal of such write-down. The second, loss on restructuring in the activity and reversal of any provision for the cost of restructuring. The third is gain or loss on the disposal of item property, plant and equipment or investment. The fourth is liquidation, settlement, and the last is other reversal of liabilities. Income statement reporting. Net income. Net income, also called net earning, is calculated as sales minus cost of goods sold, selling, general and administrative expense, operating expense, depreciation, interest, tax, and other expense. It is a useful number for investors to assess how much revenue exceeds the expense of an organization. This number appears on a company income statement and is also an indicator of a company profitability. Represent the income after all. Number 1, revenue. Revenue is the income that a business has from its normal business activity, usually from the sale of the goods and service to customer. And number 2 is expense. Expense is an outflow of money or any form of the fortune in general to another person or group to pay for an item or service or for a category of cost. For the period are considered viewed by many as the most important measure of a company's success or failure of given time. Other reporting issue: accounting change and error. Change in accounting principle. The first is retrospective adjustment. The second is cumulative effect adjustment to begin retained earning. The second, approach preserves comparability across year, and the last example include and number 1, change from FIFO to average cost, and number 2, change from the percentage of complete to the complete contract method. Accounting change. Change in accounting estimate. The first, account for in the period of change or the period of and the future period if the change affects both. The second, not handle retrospective. The third is not consider error, And the last example include in number 1 is useful life and residual value of the depreciable asset. The number 2 is uncallable receivable, and number 3 is inventory obsolescence. Other reporting issue: retained earnings statement. The retained earnings report is a basic financial statement. This report describes changes in the company's retained earnings during the reporting period. It breaks down changes in the interest of owners in an organization and in the application of retained earnings or surplus from one accounting period to the next. In case number 1 is net income, change in accounting principle, period adjustment, and the case is number 1 not net loss, number 2 is dividend, number 3 is change in accounting principle, and number 4 is period adjustment.
Comprehensive income is all change in equity during a period except those resulting from investment by owners and distribution to owners. Includes all gains and losses that bypass net income but affect equity. The component of other comprehensive income is 1. A single continuous statement or one statement approach, and 2 is two separate but consecutive statements of net income and other comprehensive income. And other reporting issues required in addition to a statement of comprehensive income is 1. Generally comprised of, and 2. Share capital ordinary, and 3. Share premium ordinary, 4. Retained earnings, and 5. Accumulated balance in others comprehensive income. Statement of change in equity. Report the change in its equity account and in total equity for the period. Includes accumulated other comprehensive income for the period and contribution and distribution to owners and reconciliation of the sharing amount of its component of equity from the beginning to the end of period.